Hey everyone, please don't run away. This may very well be one of the most important videos you'll see in a while. And, we'll get back to where we were with coming in on our intro with oil. Let's just have a look at the market in general here and see where we're at. Looking at the NASDAQ, the US 100, just hanging in there. We actually closed below this candle here. Not at all positive. We're breaking below this channel. You've got a little bit of life support left hanging on this tail candle. A close below that, and we're really prepared for the market to go down. You could, at the very minimum, it's if you were to buy at this point, you know where to put your stop loss. It'd be very tight right below here at 13,758. The downside is we got to keep in mind we've got algo traders, people using these indicators, the bots that are using the algorithms. I don't know about many of them that are gonna buying when we're below all of the moving averages. The SPY, the Dow Jones is the same. We look at something like Tesla. Again, just barely hanging in there. Below most of the moving averages. We broke below the 200, closed below the 200. If we go look at Netflix, anyone who's been following Netflix obviously knows that was taken behind the woodshed along with Meta. I apologize, the computer's a little slow here. Again, yeah, you're catching a falling knife, dead cat bounce, whatever you want to call it. It's tough. It's a tough go from here. And I know people have been spoiled. We've had some great runs on the markets, and everybody's looking to where to put their investments. Let's just keep going here. We'll look at Bitcoin. Bitcoin, it really has been following the rest of the markets. There's no real surprise here with Bitcoin as to it doing anything different. So we are definitely below all the moving averages. The MACD is turning down just as we were on the other markets. We're at a support line. You could argue to say this is a buying point, but we kind of got broken out of this channel. We were really hoping to hold. We came back into this channel. We did not hold. We broke back out. So our next line of support is going to be where this green extended out here around 33,000 again. But it's not good. We're getting we're going to start making a new channel of resistance. Go back, see what we had Solana that we're covering. Again, right there, right on that tickle point, below all the moving averages, downward, long-term downward channel. I mean, we're into months, and this is not uncommon when we're going to have quantitative tightening and the Fed's going to start raising interest rates. All of these growth investment opportunities are really just no longer attractive. We got Cardano. I mean, we've even broken down below. It looks like we're back testing into what was support. Now it's resistance. That's just even more ugly. Gold, definitely, we broke out of a long-term channel coming down here. It might take a minute here till it comes in. This is a very bullish sign. We're above all the moving averages. We broke out of a resistance channel, which was probably at least a year and a half long, coming all the way from 2020. And there isn't a whole lot of resistance as we move forward. So uh, we got inflation challenges ahead. Gold's looking like this is the place to be to counter the inflation. You know, we've seen at times when the market goes down, gold sometimes goes down with the market. People are maybe covering their margin calls and using their what they have for gold to cover it. Not so much the case this time. So, um, you know, these channel lines, you can see here we got a little resistance, but that's to be expected. I think we might chop around here for a little bit, and I mean, coming out this is just wildly bullish. Breaking above this green line here is really just anybody and anyone who trades or who has got their computer algorithms going or their trade signal indicators would have been signaling here just last week that this is a screaming buy. And I think this is probably a pretty safe bet. To oil, we've been following oil really closely here, and you know, this is kind of our feature of this video, and I want to go into depth here because I think there's a stigma with oil, and I think a lot of people are under this understanding that oil is dead, and you know, we don't, as cars come off the road, we don't need oil, and it's really actually not true at all. You know, everything that we use and consume has a carbon footprint, and it's going to be coming because we're consuming oil of some nature, whether it's petrochemicals, the plastics, you know, and that just means going out to a restaurant, going to a hotel, going on vacation, buying your things online, buying any of your things for your home. You know, and you know, you could argue and say, well, do we just stop consuming? Can we stop consuming oil? And you know, well, then we don't have an economy. So, you know, and a lot of bad things can start happening when that happens. So it's a tough situation. You know, so you know, you kind of wonder what do we do? And honestly, looking at this super bullish trend here with oil, we knew 95 was going to be some resistance. You know, I think there's even a chance we come back down into 83, 84 range, just to kind of, you know, come back in and retest what used to be resistance and now is going to be support. We did a small retest here, that 84, 85 range. We may do a larger one. That all said, I will bring you to comparing where we were back in 2008. You know, this is very similar. So 2008, we had a fairly steep climb here up into this $90, $95 range. These two charts side by side are ranged right in the same and expanded across the same time period, just to kind of give you the same perception of steepness of angles and what oil did. So, you know, for us to play around here into this $90, $95 range for some time, you know, we might have had several months there back in 2008 until we really stepped out and broke out and got into that $100, and then we hit some resistance, and then, you know, kept going up to ultimately 150. So, you know, we are going to say, okay, well, are we going to replicate what happened in 2008? Is that possible? You know, we look, here's our latest supply demand chart. We were actually over at 101 million barrels per day on the global oil demand, and then it dropped back down about 3 million barrels in January to touch in with the global oil supply. Now, how accurate that is, January is a bit of a month of a slowdown month. I look back through other Januaries, so it's not unreasonable. Usually we should be stockpiling oil and our petroleum reserves through the winter. Um, it'll usually the summertime when everyone's traveling and driving is when usually our reserves start going down and the demand outstrips the supply. So we'll see what happens. I think we're still very much inclined to continue this trend up, and I think 105 million barrels per day of oil is not out of the question for 2022. Looks like economy's opening up, travel bans are getting lifted, and everyone's kind of sick of sitting at home. So myself included. So I think we are going to see some changes here and a pretty abrupt global oil demand. Now, with that said, can we keep up? So I'm going to go into a couple articles here that I pulled out. Shale has been one of the biggest things for the United States, and shale oil. And we have Devon Energy here saying, basically they're committing that they will not boost their output more than 5% this year. They even go on to say, I think we had Pioneer just as well. They were basically saying the same thing. They're going to be very disciplined growth strategy. And, we're seeing that with a few other companies. Shell is saying the same thing. On the contrary, Exxon is saying no, they're going to go ahead and ramp up their shale oil drilling. But there is still not it's not a fast turnaround. So we pulled up this chart before. We're looking where we were back prior to 2020. We won't get back to that output in the US until, mid 2022, late 2023 at best. And on top of that, we've got Mexico is planning to end crude oil exports in 2023. So, we're looking at Pemex exported 1.9 barrels of oil to refineries at its peak in 2004, but right now we're going to reduce exports to 435,000 in 2022, and then basically in 2023 that ends. And they want to basically take all of their crude processing of that 1.5 million barrels and 2 million in 2023 and process that themselves. So we've got a super tight market, and we'll get there. I'll show you a few other things here, but I wanted to kind of give you a basis of, we're not getting this massive oil influx back into the market that's going to meet demand. And so, with that, what our companies are looking at, and most oil companies in general. So if you want to compound this situation, is that it's a fundamental, if not a disruptive, change in thinking. So we're going from an investment, high capex, continually spending a bunch of money on oil and exploration or refineries and technology, and we're switching over now to taking these debts and basically taking the surplus and just paying off debt. And then once the debt starts getting paid off, they're putting that money to the equity shareholders. And so this is, turning what we used to take as a value field of investment, where we were maybe averaging a 15 to 20 price earnings ratio, or right now we're probably about 10, and that kind of flips it around to where this would be more like a growth type investment, where we're seeing all of this money coming back into shareholders and on all of these gains that can be coming in. So to the point where they actually, within a few years, they can start buying up, if not all of their shares. So if you think about the ultimate ownership of something, even if you're to go back to Bitcoin, this dwarfs the whole halving theory of Bitcoin, where there's still more Bitcoin coming out, but every so many years it halves the amount of Bitcoin that is produced. Well, this, in so many years, we're going to have the actual amount of shares in circulation at the rate we're going here. So, and this is what I want to get you guys to really wrap your head around. We need oil. Unfortunately, we're not going to be running around just with wind and electricity, wind and solar without oil for several years yet. And so there's a real once in a generation buying opportunity here to buy into some good oil companies and turn out a really, really generous profit, if not a massive profit. This was another chart from Rystad Energy, just showing cash flow from operations. I mean, we're going back all the way to 2014. We've never had the cash flow exceeding the capex. Capex, which is your capital spending on future projects, is just going down, dwindling, and we see this everywhere we look on with other companies and what their future projections are. A lot of them, they've tried twice to really ramp up hard, especially in the States. OPEC kind of punished everyone, drove oil prices down. But I think there is a bit of a false danger there. I don't know if OPEC really has the resources now to cause that sort of grief that we've seen in the past, but we'll keep going through here, and hopefully this helps clarify. So this is from last week. This is the summary of the weekly petroleum data for the week ending February 11th. And this is interesting. So what I wanted to point out probably in the middle here, so what they came out with is that the U.S. commercial crude oil inventories, excluding those in the Strategic Petroleum Reserve, increased by 1.1 million barrels from the previous week. And that the day this came out, I mean, oil was right at $95, and it had to turn. Traders, I know, were going to short it down from $95. That's, the chart was pretty much spot on that. But ironically, this 1.1 million barrel of inventory increase, and I really will highlight excluding those in the Strategic Petroleum Reserve. Why do I say that? Well, let's go have a look and see what it was. So here we are. The commercial crude oil inventory last week went up 1.1 million barrels, just like the previous article. However, our Strategic Petroleum Reserve went down 1.6 million barrels. Interesting. So if we look at our total stocks of all of our distillates and our gasoline and our kerosene and jet fuel and the diesels and the propane and the propylenes, our total stocks went down, including the strategic reserves, 12.6 million. If we excluded the strategic reserve, we're only at minus 9.9. So there's a difference of 2.7 million, just as there is here. So we actually, in the last week, took 2.7 million barrels out of the strategic reserves, only to come back and have the EIA say that we gained 1.1 million barrels of oil. So, is there something there? This is probably how they normally report their oil, but, something to keep in mind. Losing 12.6 million barrels of oil in a week is, we're looking at, this is almost 50 million barrels of oil a month. And when we start looking at the numbers, it'll all start making sense here. So US crude oil stocks, just to put this graphically, just for crude oil, you can see we're basically the lowest. So if we take this gray range, this is the 5-year average range. So where we were over the last 2.5 years is the blue line, where we are today here, and this kind of represents where we have been at this time of the year over the last 5 years. And you can see with crude oil, we're actually the lowest we've been in 5 years. Distillate, the lowest we've been in 5 years. Kerosene, the lowest we've been in 5 years on the average. And residual fuel oil was the lowest we've been over 5 years in this time frame, and basically ever. So get a real bear down on that number. I went and took the total reserve, including the SPR, and we are at about 165 million barrels of storage. That brings us actually right in line to where we were in about 2008 to 2014, when we were, we shot up. Remember, in 2008, I guess we were a little lower here in 2008. So 2009 to 2014, and if we look back at the oil chart, we'd see we're averaging around $90 to $100 oil. Where we dipped here in 2008 was about 1.6, and 1.6 or 1.55, I think 1.6. We're not far away, and if we're losing $50 million a month, we're literally a month or two away of hitting to where we were at 2008 levels. And as you can see by the downward slope of our crude oil and petroleum products is quite aggressive. And this is a time where we're coming out of we're a huge slowdown, where we were just a year and a half ago, we were running out of places to put oil, and now all of a sudden we're struggling to make up with the demand. So it's definitely something we'll be watching closely. We'll get a new number on this on Thursday, and I'll keep you guys up to speed on what's happening there. Globally, we were looking just in the States. Globally, 5-year average on inventories, was up here 2,800. We're down here 2,600, or 2.6 billion, 2,600 million barrels. And so, we got to say, well, will the refinery start picking up? Can we start making up this shortfall? And how will that look? Or, so we went and we looked here. We've got some time before the United States can ramp up. We're not sure how fast the rest of the world can ramp up. And there's been some warning flags there prior to 2020 that maybe some of the OPEC countries are already, maxed out because they're not hitting their quotas. Africa is one for sure, where they must have quite tight oil there, and they're not really meeting their quotas. Demand wise, we're still looking, what are we peaking here? Almost 120 million in 2030, 2035. We're still on track for 2025 to be at 110 million. So we're at 101 or 100. And in 4 years, we got to go up, we got to find 9 million barrels of oil. And, for those, if anyone's watched some of my videos in the past, I had this up, you're going to say, okay, well, really, are we going to use this much oil? Do we need this much oil? But, we've got here in yellow jet fuel. We've got net gasoline. We've got the petrochem that's continuously increasing. So that's the point, is it's all of these other things that we're buying and building and shipping. It's still using oil, and we're not going to stop using it, as quickly as we think we will. So in Europe, I don't know if anyone's aware, but in the last few months, natural gas prices have really gone through the roof. So you can see we're quadrupled the average here from what it's been over the last 10-15 years, even from 2008. I think this worked out to we topped out at about $360 barrel equivalent is the cost of gas, because of this gas shortage, averaging around $300 barrel equivalent. And you go, well, okay, that's gas. They're obviously in a massive shortage. We're not going to see that here. However, if we look at this European gas inventory chart and we look at where they are right now, below their 5-year average, and now let's look at that compared to the global oil supply 5-year average and where we are now. So does that mean we're going to see $300 oil? Well, the problem with oil is there is a demand destruction. So at some point, as the price of oil keeps going up, the demand will start to collapse. But, you have to ask yourself where we've been and what we have coming forward in the next year. Everyone's making plans to travel. If it costs twice as much to fill up your gas tank or twice as much to book your plane tickets, how many people are going to say, no, I'm not going to do that? Especially if we think prices could keep continuing to go up. People might be saying, you know what, this is the better do it now than never. And I think we're going to see a very high oil price until we start seeing a mass, significant demand destruction. So, now we're looking at, well, where else in the world can make up the supply? Maybe the rest of the world is going to catch up here, and we'll start re-inventorying our depleted stocks. Right here we've got from a company, Pareto Securities. They're forecasting from the OPEC Plus companies spare capacity, and as you can see, this is not at all an increasing scenario where we're going to see these countries start bringing in and filling in the gaps for oil demand. Even just, our shale oil drilling, we've looked at this before. You can see the moment you stop drilling, you're immediately impacted on how much oil we're producing. The Permian down in Texas is not as bad. There's probably a little more longevity there out of every hole they drill, but the rest of the shale, the Marcellus, the Bakken, stuff like that, there, whatever drilling does go into there, it starts depleting quite quickly. So you can see, for us to get back up even to this predicted model, when you look at a chart like this, is going to take a lot of drilling. And, drilling costs are going up. I think the frac sand has gone at all-time highs. Companies are leery to put a bunch of money out there because they don't want to get hit again and have these depressed oil prices by, some nature of some country flooding a bunch of oil into the market, which again may or may not be possible at this point. Iran is probably our only one left here. If we looked and we could actually remove sanctions on Iran, and we had some sort of diplomacy there, Even at best case, we're looking, a year at the end of the year, so we might have another million barrels, a little over a million barrels of oil coming in to the market, but that will basically replace what Mexico's pulling out. And that's, and if our OPEC countries are dwindling and we're really fighting to get our shale oil to come up, you can see there's I think to get to this 105 or 110 or 120 million that we were predicting is there's going to have to be a pretty significant price increase to really push that envelope and push the drive to start reinvesting and getting oil companies, wanting to invest in oil again. And, it's globally, I like to look at this Baltic Dry Index. This is a decent indicator for shipping and kind of tells you where we're at for what global demand is for products. And we had a little spike up here, and then maybe we've had some delays with our ports that are holding things back, but we're still fairly high. If you look over the last 20 years, we're at the higher end of this average. Likely coming out of the situation we're in, we're going to keep going up, and so that's going to drive on our oil demand. Going back to what the oil companies are doing with their oil and hedging oil, I've talked about this commitment of traders. You can see our commercials in black are not hedging. I mean, they were hedging, they were shorting and selling a lot of futures contracts of oil coming into the early 2020. And of course, the price of oil went down, and all the non-commercial guys buying in on those contracts were kind of left holding it. So the market is run by the commercials and the oil companies, and you can see when they're either buying, net buying. So, some are shorting, some are buying. This is the net, the total, addition of both to give you that net value. But we're still in a buying mode. I mean, we're not, definitely not at a sell point here where I would say, oh, let's be cautious. Oil companies are really unloading here. So I think they see the writing on the wall. I think everyone is seeing that we're coming into a supply crunch, and they're not selling. They're not forward selling. And finally, we looked at this, the money supply. If you take that real M2 and you tried moving these around where they best kind of at least were together with gold and oil as best as possible for many years. And you can see this big disconnect here. Oil really fell out in 2014. Gold kind of fell out and caught back up. And as our money, our M2 continues to grow, I mean, this is just going into March, and I think we're looking at $160 oil. If oil were to come back in line with the amount of money in the hands of the public, comparatively, that's where we should be. That would be an average, let alone if we were to go on the high side like we did in 2008. A valuation of oil might go to 300. We don't know, but I mean, that I'm just trying to put that, this could get very expensive going forward, and owning some good valuable oil companies that are going to start buying back their shares and start paying high dividends is a great hedge for the average guy like you and me to at least compensate for those extra energy costs that we see coming forward. So hopefully stuck through all this. I know there was a lot, but I really do believe that this is all very important, and I think really we're at a buying opportunity of a lifetime. So please hit that like and subscribe, share with your friends, and I I will, few days, maybe a week, we'll look at this all again. We'll see where our inventories are, see what the supply demand chart looks like, and I will bring you another video.